Good afternoon to everybody following our program. This is the first video on our channel, which is a sister channel to our educational program, which is the biggest crypto channel in Macedonia under the name Cryptoeconomics. What we are going to do is we are going to replicate our educational program from the Macedonian channel to our English channel, and we are going to extend it in the future with new, I would say, materials regarding everything you need to know about crypto, basically, and additionally, any connection that the blockchain technology has to the macroeconomics and geopolitics in the world. Now, first and most important, this presentation is part of our course, which is the first actual video of the same, where we explain the basics that every beginner needs to know when they're investing in the crypto sector. We're going to go through three basic categories, and we're going to explain everything a basic beginner investor needs to know when entering this field. Now, firstly, as we can see, there are three basic categories that we need to look into when we are deciding of investing in a certain project in this field. The first one is obviously directly the technology that we are investing in. This is the technical and fundamental analysis of the crypto sector, particularly the project we want to invest in. The second one is the analysis of the global economy, which definitely affects the crypto sector in general and obviously the projects that we're investing in. And the third one is the analysis of the geopolitical scene, which also affects in some cases the crypto overall sector and obviously the projects that we invest in. We're going to start with the first chapter, which is the technical and fundamental analysis of the crypto sector, in this case, particular project. And we have two subcategories, where the first one is the technical analysis and the second one is the fundamental analysis of a project that we invest in. The technical analysis is the analysis of previous charts and price changes of certain capital goods, in this case crypto projects, in order to determine the probability of their future movements. Because we have millions of traders and investors who follow and use the same charts, formations, levels, indicators, etc., which means technical analysis is the prediction of the trading emotion of the majority of market participants in order to make a profit. What we're trying to explain in short is that all these special, I would say, indicators and in this case charts and formations are showing us how the buyers and sellers were behaving on the market, and in this case we can actually have a better understanding of what is the probability of the market going on one or the other direction. So as we can see over here, we have different types of, I would say, parts of the technical analysis, starting with levels, formations, candle shape, indicators, comparison of multiple capital goods on the same chart. But even though it's looking a little bit complicated, trust me, when you go into it slowly through our course, you will start to understand it better and better. And there is nothing better than being able to do your own analysis instead of hoping that somebody else's analysis is correct. Now, what we can see here is a standard chart on TradingView of the Bitcoin price. What we also can see are different types of, as we said, indicators and formations. The first that we're going to speak is the channel formation. As you can see, this is a behavior of the price itself in a certain path, as you can see. And all these corrections are actually more or less determined by the emotions of trading of the buyers and sellers of this particular capital good, Bitcoin. Why is this important? Because once we have established the first three dots of a formation, in this case the channel formation, usually buyers and sellers will be more concentrated, in this case buyers on the lower part of the channel and sellers on the top part of the channel, as we have seen in this particular case, which means this is just a basic psychological, I would say, instrument that helps you determine when is going to be the best chance to buy and sell, depending on what you expect the traders en masse to do. In this case, also we have the time intervals, which actually gives us like a special behavior of the price chart in certain time, in this case in a yearly basis. But don't worry, we're going to talk about it further on when we get to the actual technical analysis. This is just for me to explain to you the basics. As well, Fibonacci tool, this is a special instrument that shows us levels of potential selling, in this case, from a previously determined levels of the Bitcoin chart, which means, as you can see, it particularly determined the first, second, and third level of selling, where we can see that there is a start of a new candle. And all this because of the psychology of the trader, because there are millions of people using the same tool in the same way, expecting the same results. So practically, as we can see, it actually really happens on the chart itself. Trading volume, it shows us how much of the volume of trade we have in a particular candle. Obviously, candles are time frames. In this case, one candle is 1 month. So the movement of the price of Bitcoin in 1 month is represented in one candle. Don't worry, we're going to have a special video for this only, but we're just trying to show you basically what this, I would say, special parts of the charts are. Bollinger Band as well, these are practically the lowest and highest price in a, I would say, median range from the whole chart so far, where we actually can see that usually the price bounces from one and the other side occasionally, which means that practically goes from the oversold to overbought levels during the duration of the chart. As well, we have a separate, I would say, second chart, which holds a very complicated instrument called Market Cipher B, which actually contains several different indicators, which also show us when the price is too high, too low, when is the best, I would say, probability to buy and best probability to sell. But again, this is not the only thing we're following. Obviously, this is just one of those, I would say, helping instruments to give us a better understanding of where currently the market is. The second part we need to understand is the fundamental analysis. Aside from the technical analysis, we also need to understand what is the capital good that we are investing in. For example, in the fundamental analysis, we are actually taking in the factors that influence the price movement of a particular cryptocurrency at the moment and in the future. Why is it so? Because with a complete analysis of all the details surrounding a project, we have a much better picture of it and a much better opportunity to determine the likelihood that the project and its token coin will gain greater value, as well as to protect ourselves from potential bad projects. Now, how do we do this? We need to have a better understanding of how the project functions, what the project does, what type of problem it's trying to solve in the real world or in the blockchain sector. And by doing so, we're actually accumulating information which are valuable to understand if this project has better probability of succeeding or not. As you can see over here, there are several examples, like the actual application and practical use. As we said, why is this, I would say, particular project very important? Tokenomics, we need to understand how many of these tokens are in circulation, how many of these tokens are in the hands of the team, the foundation, the VC, venture capitalists, type of blockchain. So we need to understand how does it function as a blockchain itself, the technology, active roadmap, ecosystem, project news, partnerships. All these are very important news for us to understand what is the future of this project. Obviously, nobody has a crystal ball, but this gives us better probability to understand where this project is going. Also, something that is a very big plus on the crypto sector is that all this project has, I would say, on-chain data, which is very different than the traditional companies. Why am I saying this? The traditional companies, you are practically tied to these reports that are given out from the company every 3 to 4 months. On the other side, when we're talking about blockchain projects, you have 24/7 surveillance of these projects in certain, I would say, characteristics of the project itself, especially in this type of technology, the blockchain technology, which gives you a lot better transparency and a lot better way to follow the actual working of the project. For example, these are several of the transparent characteristics of one blockchain, which are available 24/7. Tokenomics. Practically, we can see in the future what is the vesting schedule of this project. What does that mean? That means, in this case, the vesting schedule shows us what will be the future inflation of the project itself. So in this case, we can actually see how the inflation will be rising of this particular project in the time frame that is represented in this special, I would say, chart. There is a lot of this on-chain website that are doing this for us, and we will know practically how more of these tokens come into circulation, more probably it will affect the price to go down. So this is very important tool that we are using to determine the future token or coin inflation of a certain project. Then we need to know what is the exact amount of coins in circulation right now, and how many would be in the future. For example, if there is a total amount or there is an unlimited amount, if there is a certain inflation that is implemented in the project itself, instead of the vesting schedule, which is when you actually give the tokens to somebody. Over here, you give the tokens usually to the actual nodes that are running the blockchain. So practically in this case, we can actually see what is the basic yearly inflation of the coin over time. So we can know practically how it will diminish in price, if any diminishing in price will actually occur. Depends on the project itself. Then we have the tokenomics. This is the special part of the tokenomics about the distribution of the coins and tokens, where we have the certain amount of coins that are given to, in this case, the DAO treasury of the actual project. We're talking about Arbitrum in this case, the actual foundation, the team, the investors. So in this case, you can know how big of an influence they will have on the project in the future. For example, if the team has 27% of the total amount of the coins, it means they will really have a big amount of influence of the project in the future decision making of the project itself. And more some of these categories have percentage wise tokens, more the influence will grow. Blockchain type as well. In this case, you will actually determine if a certain blockchain type you prefer more or less, depending on the technology that these projects are using for their basic mechanism of functioning. Then active developers working on the project. These are just some of the basics. We have more than 30 of these separate indicators that we follow for every of the projects that we invest in. In this case, active developers is how many actual developers are developing the project. So we can actually see on-chain by the special data they are depositing in the GitHub repository, practically of how many of these, I would say, special developers are actually working on the progress of the project itself. More of them, obviously, we're talking about better chances that the project will be a success. These are the top 100 wallets of holding coins and tokens. Similarly to what we saw here in the separate, I would say, categories, over here we can see them by wallet, which means this any wallet has a very large amount of coins, otherwise tokens. We're talking about a very unstable project which can be influenced by this wallet in a very bad way by dumping the coins on the market and practically destroying the price, or the other way around. More we have decentralized blockchain, it means that they have more wallets with less percentage of coins in it. In this case, if you take a look at, for example, Bitcoin wallets, you will see that there is only 1 or 2 wallets that have more than 1% in them of Bitcoin total amount of coins. And then onwards, you will see a very large decentralization of very small amounts of coins in a very large amount of wallets, which means it's a lot less probability that somebody will practically influence the price in a bad way, since nobody has a lot of coins in their wallet. Project ecosystem, it shows you how many decentralized applications are built on a certain, in this case, layer 1 type of project, which means shows you how the project is growing. Since on Arbitrum, again, as layer 2, there can be decentralized applications built. You can see that they have a vibrant ecosystem, which means that there are several different applications in different categories like derivative, oracles, cross-chain, lending, stable coins, etc., which are actually using the blockchain, which means there is a use case for the blockchain itself. Project development roadmap, which shows you how the project is hoping to progress in the future, where the team will lay out their plan for future, I would say, upgrades of the blockchain itself. And in this case, you know what to expect from the future of this project, especially when we're talking about its upgrades, right? Its betterment. Now, the second part that we need to explain in this, I would say, detailed analysis for any beginner of the actual crypto sector as a whole is the analysis of the global economy. Developments in the global economy directly affect the prices of the cryptocurrencies. As we have seen so far, the prices of every product, resource, service, including cryptocurrencies, are directly influenced by global economic trends. Short-term and long-term changes in the global economy cause a change in the level of fear among an investor to enter or exit an investment in a particular market. Why is this so important? We have a lot of these global movements in the market, which are always influenced by what is happening in the global economy. We're going to take as an example, in this case, the finance finance of the leading global economies, like the debt, the GDP, the inflation, then the tracking of the global reserve currency, employment in the leading global economies, and we're going to show you how they practically influence directly the chart of the cryptocurrencies. In this case, we're going to take obviously Bitcoin as an example. So we're going to show you practically several examples for you to see how this type of, I would say, global economic values determine what is the probability of the movement of the price of the cryptocurrencies. Now, in this chart, we can see three separate, I would say, values. The basic chart is the DXY, that's the actual dollar value. Then we have the inflation rate in the US and the level of the Fed interest rates. Now, we're not going to go into that much detail, but I just want to explain to you how the cycles are connected. Now, we have the correlation of the dollar value with the inflation and the Fed's monetary policy. That's why we, on this channel, pay close attention to the Fed's monetary policy, and we always follow what the press conference and the monetary policy on a monthly level is, the FOMC meeting, and we analyze it live while it's happening. Now, what we can see here as an example, usually bigger, although the mechanic of the federal monetary policy is quite obviously complicated, we're going to try to make it as simple as possible for you to understand how it works. Now, what we can actually see in this particular case is the inflation level, which when it starts rising because of the rise of the prices in a certain economy, obviously the Federal Reserve needs to practically raise their monetary policy, in this case interest rate, to control the inflation. How do they do that? By raising the interest rate, they're practically making the borrowing cost of the commercial banks, which are borrowing from the Federal Reserve, a bit higher. In this case, obviously, the borrowing will slow down because now it costs more to borrow money from the Federal Reserve. And on top of that, let's not forget that they will even try to pay back as much as they can from what they've borrowed before, because the interest rates are rising. So it means that they need to pay more and more every month. So when that happens, obviously, as they are practically growing the interest rates, less money are in the economy. Why? Because all these commercial banks, when they start practically paying back to the central bank, in this case the Federal Reserve, more and more, they make less money available on the markets, which means more of this money is coming back to the central bank, and in this case it exits the liquidity of the markets. And as we can see in these kind of situations, when that happens, it raises the price of the dollar, because we have less dollars available on the market, because most of it is going back to the central bank, which is currently raising the rates. And in this case, practically it makes, as you can see, the dollar rise in price. Now, when that happens, we have less liquidity in the markets, obviously, because of the bigger interest rates. People are less interested in buying, and as they stop buying, obviously the prices of everything starts going down, because in this case, if there is interest, obviously for the producers, they have reason to raise the price. And then the other way around, when in this case the interest is gone because of the high rates of the central bank, in this case the Federal Reserve, obviously the interest is going down, and obviously the inflation will follow because the prices are being lowered. Now, why is this important? Is because these two values, the inflation and the Federal Reserve monetary policy, in this case the interest rate, are determining the value of the dollar. So higher the rates of the Federal Reserve, higher will be the value of the dollar, and the other way around. If they practically lower the rates, the value of the dollar will diminish. As we can see over here, when the inflation is going down, obviously there is no need for the Federal Reserve to keep the interest rates high. So what they do, they lower the interest rates, and what we can see that the dollar follows. The value of the dollar is being less and less, because with the lower interest rates, obviously, everybody is more incentivized to borrow. So it means they're borrowing more actual money from the central bank, which means more money in the overall liquidity pool of the economy, which means that more dollars leads to less of its value. On top of that, the national debt is as well one very big, I would say, indicator for the stability of a certain economy, especially in the US, since the US is the economy which has the reserve, the global reserve at the moment in the world. Now, how is this? The first case is actually more important, involved in the actual price of the cryptocurrencies. We're going to determine, once we determine one more value, which are the three basic values that we follow in a certain economy, especially in the US economy, to determine what is going to be the value of the dollar. Because at the end of the day, the dollar is counter, I would say, in value of everything else, including the cryptocurrencies. When the dollar rises, obviously, everything else falls in value. Again, cryptocurrencies included, and the other way around. When the dollar loses value, we have growth in value of everything else. Why? Because everything is priced in dollar, which means less the dollar is in value, obviously everything else will be higher in value, because there will be more dollars needed to buy a certain good on the market. Now, the third value that we need to add, beside the inflation and the federal interest rates, is the unemployment. So opposite of the inflation, the unemployment is the second, I would say, force in the market that the Federal Reserve is trying to keep in check. And in this case, when we have higher practically unemployment, in this case, Federal Reserve needs to lower the interest rate to incentivize the economy. Why? Because when the inflation is high, then the Federal Reserve needs to make the interest rates high, which makes the economy stagnate. When the economy stagnates, what happens? Obviously, all these factories and producing, I would say, entities are starting to lay off workers. And obviously, these are two cycles that follow next to each other. When we have a situation where practically the Federal Reserve interest rates are high, they are, as we can see, making periods of high unemployment. What's happening next? The Federal Reserve is lowering their interest rate to incentivize the economy. What happens? The unemployment follows, which means that more the lower the interest rate of the Federal Reserve, more dollars on the market, more incentivized buying, more production, obviously less unemployment. So as you can see, this is constantly the same. Every time that the unemployment rises, the Federal Reserve is lowering the practically the other way around. The orange line is the unemployment line. So what we can see is that every time that we have practically high unemployment, so the only way the Federal Reserve can control the unemployment when it's high is to lower it. So when it lowers the interest rates, it practically makes over time the unemployment go down. Again, we can see that every time that the unemployment was high, the Federal Reserve was lowering its interest rate to practically incentivize the economy and lower the unemployment. In absolutely every situation, we have the same practically success so far to lower the unemployment. But why is this so important? Because usually the high unemployment is actually showing us that we are in a, I would say, bottom of a certain market, where the lowering of the interest rates is practically starting the incentivization and starting the bull market itself, which leads to, I would say, first of all, lower prices of the DXY, and obviously higher prices of everything else. Now over here we can see the correlation of the value of the dollar in relation to the value of Bitcoin and the S&P 500. As we've seen, the unemployment and the inflation through the interest rates of the Federal Reserve are practically determining if the dollar will be rising or it will be falling in price. In this case, what we can see that every time that the dollar will be falling in price, as we already mentioned, we can compare the prices of the S&P 500, which is the biggest index in the traditional markets, and the Bitcoin, which is the biggest cryptocurrencies. We can see that every cycle of lowering the value of the dollar, which was, as we said, determined by the inflation and the unemployment through the adjustment of the interest rates of the Federal Reserve, makes everything else jump in price, including, in this case, the S&P 500 and the Bitcoin. The other way around, when we have an extended period of growth of the dollar value, we can see lowering of the Bitcoin and the S&P 500 prices, which means they are counter, I would say, correlated. They are reverse correlated one to another. And in this case, obviously, this is why we need to follow these big trends to determine what is the probability of the, I would say, capital good that we invest in to go up or down. It doesn't matter if it's cryptocurrencies or traditional markets, it will be the same result. Also, something that is very important is the correlation of the price of oil, in this particular case, and the dollar. Now, again, don't forget, these are just some of the correlations on the market. There are a lot of them, but these are the basic and the most important. And what we can see that usually the price of the oil is deeply correlated to the price of the dollar. Let's not forget why, because of this special agreement that there is between OPEC countries, including the leading country, Saudi Arabia, and American economy, that all the oil that will be sold through OPEC in the world will be sold in dollars, which means that this is the only current value of this, I would say, green toilet paper that we call dollar today, that actually has some kind of backing for the dollar to continue existing. And as we can see, more practically we have a rise of the price of the oil. Obviously, we have a rise of the price of the dollar because people need to use more dollars to buy the same amount of oil that they could have bought, for example, 2 months ago. As we can see, this is in the start of the Ukrainian war, which we know, as an example, made the prices of oil explode. So doesn't matter. We're not going to go into the supplies why it actually exploded. What is important is that more you need to pay for 1 barrel of oil, more you need to have dollars to do so. And more you take out dollars from the market, obviously there are less markets in the global liquidity pool. That means that the dollar will practically rise in price. As we can see over here, they are deeply correlated between themselves. So aside from the interest rates from the Federal Reserve, the second most important power that determines the value of the dollar is the actual price of the oil, as we can see. Also, there is a correlation of the bull and bear market between traditional markets and crypto market, correlation of stock value with the value of cryptocurrencies of the same category technology. Now, why is this so important? What you can see over here is a heat map of different, I would say, industries and their biggest companies currently in the American economy. As we can see over here, we have software infrastructure, consumer electronics, internet connection, semiconductors, etc., etc. Now, why is this so important? If there is anything in particular that is currently connected as an industry to a certain sector in the crypto industry, usually we have them growing together. Why am I saying this? For example, currently in this bull market, I would say from 2022 onwards to today, we still have a very big growth of everything that is connected to software infrastructure, semiconductors, which is practically most used in those big, I would say, data center installations that are built all over the world. Now, this obviously gave growth to the AI industry. And in this case, we can see correlation to all the AI projects from the crypto sector that are connected to, I would say, the projects in the traditional markets. Now, even if they are not directly connected to each other, the idea that we have a currently boom in the AI sector will lead to more investors being interested in the AI sector of the crypto industry. So what I'm trying to say is that usually when we have these waves of a certain technology that is more important or more invested in at the moment, usually that follows in the crypto field as well to those kind of projects. So that's why it's very important for us to follow them. Now, these are the basic things that we can see, for example, as a correlation between the macroeconomics and the crypto sector. And the last but not the least, which is, I would say, unlike the macroeconomics, which takes a lot of time for some of these changes to be implemented and to be seen in the markets, the geopolitical scene is a lot more brutal, and it practically happens a lot faster, and it affects the market a lot faster as well. Now, this is the most critical instant category of changes that occur in the prices of all products, resources, and services, including cryptocurrencies, which instantly affects the level of fear among investors to enter or exit an investment in a particular market. Usually, everything that we see currently here is connected to this type of behavior because of the fear of the investor to invest in a market. Sometimes there is more, sometimes there is less fear. Now, as we can see, beginnings and endings of military conflict, they have a very big effect on the markets. Connection of current military conflicts with global economic trends, disruption of energy, resources, industry, economic logistics, etc. Geopolitical blocks like BRICS, NATO, using crypto CBDC from these blocks, obviously, when they start trying to avoid sanctions, like what they do right now in BRICS, they try to use in this case, crypto or blockchain technology. Geopolitics and global reserve currency, the de-dollarization process, practically the fight of, I would say, this BRICS bloc to de-dollarize, to stop the world from using the dollar as a global currency. Now, as an example, for example, we are going to take the Dow Jones, which is one of the oldest, I would say, traditional indexes, which follows the industrial average of America. What we can see here, we can see that when we compare it to the periods of war, like the First, Second World War, Vietnam War, the War on Terror, we can see that in all those periods of time when these global conflicts were active, the price, the value of the Dow Jones index was stagnating, I would say, even in a bear market. But then, when we had finishing of these, I would say, big conflicts, we had not only that it had an enormous rise in value, like after the First World War, it rose 504%. After Second World War, it rose 523. After the Vietnam War, it rose 1,447%. But it also grew over a large amount of time. In the First World War, we had a bull market starting from 25th to around 30th, 5 years. The second bull market, which is, we can see, extensive, is from 1949 to 1965, which is 26 years. Sorry, 16 years, my bad. And the last one, which started around 1980, ended in 2001, which was almost 19 years in length. What it means that the beginning of conflicts makes the market stagnate, even enter bear markets, like we saw in the 2022 bear market when the Ukrainian war started. We had a bear market for all the indexes and all the cryptocurrencies. And the other way around, when we have the end of these big conflicts, usually the markets come back into play, they start rising, all these logistical chains, they are reimposed. We have again forming of these trade ties among countries and blocks, which is the best part that we're expecting of every war, the end of it. Now also we can see the correlation of the growth of natural gas prices, food products, and value of the dollar at a time when a conflict begins in an area crucial for the food market and the natural gas. Now, what we've seen is that not all conflicts affect the global markets, but those conflicts that are very close to a certain type of resource like food, natural gas, oil, which is very important for the global markets, they definitely affect the, I would say, the markets. What we can see here, we can see the DBA index, which is an index that follows the value of food products, basic value of basic food products. Then we have the red one, the red line, which is the chart that follows the price of the value of natural gas, and the DXY, the dollar value. So on global level, again, most of the trade is done in dollars, which means, as we mentioned before in oil, the same situation here. From the moment of the start of the Ukrainian war, which was the 24th of February, it was 28th, I'm not sure, I think it was 28th of February 2022, we have had very big effect on what? Ukraine is the second largest producer of crops. We're talking basic food level crops. On the other hand, Russia is the first biggest producer of crops. So it means that the moment that this war started, we have interruption of this market. As we can see, the prices of the basic food in this food index was rising even before. But why is that? Because people were being scared that this will happen. So practically there was a big accumulation of this, I would say, index or generally basic food goods, which means that it made the price of this index and the basic goods of food, in this case crops, rise. Automatically the index price rise, automatically we have more dollars used to buy this type of products and the index itself, which means that the price of the dollar will rise. Same goes with the value of the natural gas. Again, most of the trade is still conducted in dollars, which means more dollars are used to buy this natural gas, since it's less, because the production process interrupted after this war started. The transport of the gas is interrupted after this war started. So it means that the price of the gas will go up because there is less gas to be bought on the market. Automatically, both of these goods are practically pushing the price of the dollar up. And as we've seen before, the dollar is reverse correlated to everything else, especially these investment goods that we are actually holding in our portfolio, which means when this happens, the prices of the cryptocurrencies and everything else will go down. As we can see over here, as the Bitcoin dollar value rises after the start of the Ukrainian war, we can see stagnation and fall of the Bitcoin price, which is reverse correlated, as we've mentioned before. Same goes for the oil, as we've mentioned. Now, when we have attacks and potential start of conflicts in an oil-rich environment, now over here we have taken the this is the April 2024 attack on the Iranian consulate in Syria, in Damascus. Why is this important? Because at that time we still didn't have the war on Iran started. And why is it important? Because we can see that even the fear of potentially starting on war in a oil-rich environment, or I would say in this case the Middle East as a region, makes the price of the oil go up. Why is this so? Because all these countries are trying to protect themselves by buying more oil in case there is a war that can actually interrupt the logistics and the production of oil. As we have seen 2 years after, we are in April 2026, May, just starting today, literally that happened. So now we have actual interruption and closure of Hormuz, which affects the price of the oil very much. So the same goes back then. Because of the fear of a potential start of a war that can actually do that, we can see a lot of people and companies and countries obviously buying oil, which makes this commodity less on the market. And as less we have oil on the market, obviously the price will go up. And the other way around, as we've seen, the correlation between the dollar and the oil is very big, since around 4/5 of the total amount of transactions are conducted in dollars, which means the rise of the dollar will be happening because more and more dollars are taken off the market for these participants to be able to buy oil. Automatically, we have the same result. What happens? As the price of the dollar rises because of the oil crisis, the price of Bitcoin goes down. As you can see, the price of Bitcoin slowly goes down every time that the dollar rises, which means in both cases, when we have start or development of a war in a certain region, which is very rich in certain resources that are key to the survival and progress of the global community, usually we have the same result, and we have it very fast because people react a lot faster than when this is happening in the macroeconomical part. Now, investing is an overall and daily knowledge and research of crypto, blockchain technology, the global economy, and the geopolitics that gives you the highest probability that your investment will grow in value. What I'm trying to say with this is that You focusing only on one of these three areas, unfortunately, will lead you to a place where you have just a limited amount of knowledge of what is happening in the markets. And definitely you will be surprised by the movement of the market. So what I'm going to say again is that, unfortunately, no matter if you want to invest only in the macroeconomics or the, I wanted to say, like stocks or bonds or anything that is connected to the traditional finances or blockchain technology, you need to follow all these three, I would say, categories to have a total amount of knowledge that you need to succeed in investing. On this, I would end that. I hope that you liked what we have prepared for you. This is just the first of a long series of educational videos we will have for all, including macroeconomics, especially blockchain technology, and obviously geopolitics, as a well-rounded channel that will try to bring you everything you need to know about investing. As you can see on this slide, you can find everywhere that you can actually follow our work. All this information you can find in our description as well. So thank you for enjoying our content and hope to see you in the next one. Have a good day and be well from the team from Cryptoeconomics.